Hello and welcome to the Business Standard Morning Show. I'm Binu Sandhu. Let's take a look at the stories for the day. Post-pandemic, the private sector stepped up hiring, absorbing a bulk of the skilled workforce. The IT sector took the lead in this, while others were not far behind. But what about the public sector giants? Are they matching up to India Inc. in giving opportunities to youngsters? Let's find out.
Led by the IT giants Tata Consultancy Services and Infosys, the top listed companies by market capitalization have reported net increase in employees to their total headcount in FY22, according to analysis from the annual reports. Of them, TCS closed the year ended March with all-time high net addition of 103,546 employees, while Infosys hired 85,000 fresh college graduates with a net addition of 54,000 employees. IT companies are battling high attrition fueled by a sharp rise in demand for automation and digitalization across all industry sectors. The software behemoths are compensating the same with high fresher recruitments. Meanwhile, oil to telecom conglomerate Reliance Industries recorded the highest net addition during FY22 with 107,000 employees. In the banking services, HDFC Bank and ICICI Bank added 21,486 employees and 7,094 in the financial year respectively. The hiring outlook is strong too in the near term. According to a TeamLease report, the corporates' intent to hire showed a substantial increase of 7% for the ongoing July-September quarter to 61%, and it might hit 70% in the coming quarters, largely driven by hiring from Tier 2 cities. Now, if we look at most of the listed PSUs, employee headcount has shrunk in FY22. This was the trend observed across sectors. Employment in PSUs is categorized as on-roll and off-roll. Managerial staff, supervisory and non-executive employees fall under the on-roll category. Casual and contract workers are classified as off-roll staff. India's largest state-owned bank, State Bank of India headcount was lower at 244,250 in FY22, compared with 245,652 in FY21. Indian Oil Corporation too saw its employee strength drop marginally to 31,254. BPCL employees fell to 8,594 in FY22 from over 9,000 in the previous fiscal. Meanwhile, Coal India and GAIL too saw its employee count drop. Indian Railways ticketing and tourism arm IRCTC and SBI Life Insurance are the only companies among the top PSUs that have reported an increase in the employee strength in FY22. According to a report in a national daily, the fall in employee count has been coming down for many years. SBI saw its employee numbers go up when there was a merger with 5 other small banks in 2017-18. ONGC and NTPC had reported an employee increase or hired many years ago. So, what explains this phenomenon and why are PSU companies not hiring or increasing their headcount?
So in some sense, this trend is not so surprising because after all, we don't expect public sector units to actually be the driver of employment or the key employment generator in the economy. It is actually the private sector which will have to generate bulk of the jobs. So I guess as we go ahead, we cannot expect the public sector units to be a major source of employment generation, and these trends Just reiterate that. Well, I mean, the trend towards public sector enterprises has not been one of an expansion in hiring in any case over the last few years, because as again the trends have show us right now, most of these firms last increased the number of workers in their payroll about 6 to 7 years ago, and most of the banks have actually not added employees. It's basically the private sector banks where much of the growth is happening, and the public sector banks not generating employment. Mostly the trends that we're seeing in the public sector units are coming from the banking side. So I don't think we expect these banks, the public sector banks, to be generating a huge number of jobs. And let's not also forget in the banking sector that there's a lot of automation which is going on, and that technological change will also have implications for the kind of jobs and the number of jobs which are created. People are moving towards private sector banks, then what will the public sector banks even do, like hiring more and more people? I think there is actually limited scope for job creation in public sector enterprises. So I don't think it's about them not wanting to fill the vacancies. I don't think they can generate the jobs.
Even if we accept that PSU companies are not the biggest job creators, it is still puzzling as to why there is a sustained decline in headcount. It may well be the case that composition of the staff might be shifting to different forms of employment, or the PSUs might be hiring more contractual staff and outsourcing other parts of work.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
There is hope though. Prime Minister Narendra Modi has announced that 1 million vacancies would be filled across various ministries and departments in the next 18 months. Moving on, Prime Minister Modi recently slammed the culture of distributing raveries or freebies, triggering a debate around the subject. Parties rising to power on the promise of freebies is nothing new. In this report, we delve into the subject.
What exactly are freebies? In simple terms, it refers to a public welfare measure, any good or service that is offered free of cost by the government to its citizens. But our existing legal or policy framework does not provide a precise definition for the term. In the current context, it is often used as a political term by the centre to express disapproval of certain state-level schemes. Therefore, it seems the meaning changes depending on whose perspective you hear. Free color TVs, grinders, food grains, laptops, cycles, gold, washing machines, cows, sheep, cash transfers to farmers, health insurance and fertilizer subsidies. Indian voters have been beneficiaries of all this and more. But which of these are vote-catching freebies and which are legitimate welfare measures? Making that distinction is a near impossible exercise. Let us take a famous example from Tamil Nadu, home to the two big Dravidian parties notable for their freebies, the DMK and the AIADMK. In 1982, when the then Chief Minister MG Ramachandran or MGR expanded the midday meal scheme for school children that was pioneered by K. Kamaraj in the late 1950s, he faced opposition from all quarters. The scheme drastically improved enrollment, attendance and absenteeism. About a decade later in 1995, it was rolled out nationwide by the centre. Similarly, today, the centre's PM Kisan scheme is modelled on the lines of Telangana's Raitu Bandhu scheme. These are just two of the many examples where state-level welfare schemes, once derided as freebies, served as a template for the central government to emulate. Given the ambiguity, 15th Finance Commission Chairman N.K. Singh, in a recent column, said there was a need to distinguish freebies from merit goods, expenditure on which brings economic benefits, such as the public distribution system, employment guarantee schemes, and states' support for education and health. On the other hand, a June RBI paper said that the provision of free electricity, free water, free public transportation, waiver of pending utility bills, and farm loan waivers are often regarded as freebies, which potentially undermine credit culture, distort prices through cross-subsidization. This erodes incentives for private investment and disincentivize work at the current wage rate, leading to a drop in labor force participation. But this exercise is also fraught with risk, because in the long run, the social and economic benefits of certain freebies can far outweigh the fiscal costs they impose, even if they seem burdensome in the short term. States see it as an investment in human capital. This makes labeling expenditure as merit or demerit at the time of rollout difficult.
Even the midday meal scheme was dismissed as a freebie. When M.G. Ramchandran, the then Chief Minister of Tamil Nadu, I mean, he's a mass politician, right? He was opposed by literally everyone, starting from the World Bank all the way to his own bureaucrats. But he persisted. He fought with even the then Planning Commission Deputy Chairperson, Dr. Manmohan Singh, who said, "What are you wasting this money on?" And MGR basically walked out of a meeting and asked a question. My point is, there is no way to decide what is a freebie, quote unquote, and what is not. It's just a pejorative term that's used to dismiss what I think is part of the very legitimate political process. To say that people are incapable of making their own choices and politicians are being corrupt or if they respond to those choices. The political process is all about deciding how allocation of resources should take place through the state. So this whole debate about freebies is nonsensical and meaningless. I don't think the court should have gotten into it at all. Different states are in very different positions, and it is very difficult to make a general fiscal prudence argument on this part.
If the Supreme Court is not the right institution to regulate freebies, can the Parliament legislate on it?
Absolutely not. Parliament should not. It's not its business. There is a list 2, which the state is free to make laws without being restrained by Parliament. A state should be free to make such laws on that, are constitutionally free to make laws on such topics. Likewise on list 3. So unless Parliament wants to amend the constitution and remove states from the federal structure entirely, I don't think they should touch it.
Alok Prasanna says income tax deductions or exemptions and corporate tax reductions could be classified as freebies, but they are also conscious political decisions. Does something stop being a freebie because it has the approval of the centre? Experts broadly agree that states should be free to decide on freebies if it has the money. The problem arises when states dole out freebies, merit or non-merit, beyond their fiscal capabilities. Consider the financially weak state of Punjab. It is among the most indebted states and its own tax revenue has been declining over time. Punjab spends over 13% of its revenue expenditure on subsidies, one of the highest. Yet, the ruling Aam Aadmi Party recently fulfilled its poll promise of providing free electricity to every household up to 300 units. In the backdrop of poor fiscal health of some states, is there a way to set guardrails in place to ensure that freebies don't become excessive?
There are many governments where they are getting into a situation where their policies are leading to larger public debt, and that is going to be creating a long-term debt sustainability issues. This is where we start feeling the absence of the planning commission. Right now, we don't have any institution like fiscal council, interstate fiscal council, which can really regulate the deteriorating quality of expenditure at the state level. If some state is not able to really generate more resources, I think the finance commission will actually help by transferring more resources. Once the resources are transferred, how they can spend is something, it is with the state government. That is exactly where the politics come into that. One variable which is very important, and unfortunately that variable has not been really brought to the discussion table, is the public debt to GDP ratio. In fact, if you look at one of our study that we have done for the 14th Finance Commission, we said that FRBM has to be renamed as Debt Ceiling and Budget Management Act, and we also suggested that every government, both center and states, need to bring a debt paper every 6 months and submit to the Parliament or the Assembly.
The debate on freebies also needs to be looked at from the perspective of income of states. As the centre imposed more cesses, the share of tax revenue that the centre gives them has dropped. The end of centre's GST compensation payout has further reduced the headroom available with states for social sector expenditure. As such, freebies should continue to remain a conversation between the states, political parties and the voters, with prudent measures in place to check the largesse in case of fiscally stressed states.
क्या हाल? मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है, 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Let us move on to markets now. It was a mixed session for the stocks owned by investor Rakesh Jhunjhunwala, who passed away on Sunday morning. With his insights no longer guiding investors, is it time for you to exit these stocks? Or are there enough reasons to stay put? And let's answer these questions in our next report.
Shares of Rakesh Jhunjhunwala and his wife, Rakesh Jhunjhunwala-owned companies traded mixed on the BSE on Tuesday in an otherwise a firm market. Rakesh Jhunjhunwala, one of India's richest stock market investors, died at the age of 62 on Sunday in Mumbai following a cardiac arrest. Among his holdings, the market price of Aptech slipped 6% intraday but ended flat on the BSE. Others like Star Health and Allied Insurance Company added around 0.5%, while Wockhardt lost 2%. Titan Company, the top holding in Jhunjhunwala's portfolio, settled 0.8% higher at 2,494 rupees per share after hitting an intraday low of 2,434 rupees. Rakesh Jhunjhunwala and Rekha Jhunjhunwala collectively held 5.05% stake in the Tata Group company. However, Tata Motors DVR, Orient Cement and DB Realty gained in the range of 0.5% to 4% on the BSE. In comparison, the S&P BSE Sensex settled 0.6% higher. Rakesh Jhunjhunwala and his wife Rekha Jhunjhunwala held over 1% stake in these companies till the end of the June quarter. According to analysts, the impact of the development will be short-lived on these stocks.
Whenever a marquee investor passes away, there is always a fear as to what would happen to his portfolio, whether his heirs will sell it out. However, in case of Rakesh Jhunjhunwala, it seems from the reports that the succession planning was in place and he has professionals running his family office. And the key people, I think, have been there with him for decades. So I really don't expect a major change to happen to the portfolio, at least in the near future. Though there could be a bit of sentimental impact in the market.
A.K. Prabhakar of IDBI Capital too believes that the decision to stay with these stocks should be based purely on how each of these companies is performing fundamentally. He says that the stocks can see a knee-jerk reaction and can bounce back. Investors will be better off basing their decision on the fundamentals of these companies rather than getting carried away. On Wednesday, the markets will await minutes of the US Federal Reserve minutes of the July meeting. Besides, the Eurozone's Q2 GDP data will also be released today. Back home, stock-specific action will continue to guide investors.
तुम इतना डर गए?
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Staying with the markets, a depository receipt is a financial instrument that allows people to invest in the shares of foreign companies. In our next report, we talk about the different kinds of depository receipts.
Depository receipt or DR is an instrument used by domestic companies to raise money outside the country. Now, some of its examples are American Depository Receipts or ADRs and Global Depository Receipts (GDR). American Depository Receipts or ADR is a type of stock that allows US people to invest in non-US corporations and receive dividends in US dollars. Indian enterprises who want to raise capital in the United States can use ADRs to achieve so by issuing shares of any of the American bourses. The ADRs are governed by the Securities and Exchange Commission. They trade in US dollars and clear through US settlement systems, allowing ADR holders to avoid having to transact in a foreign currency. Global Depository Receipt or GDR are like ADRs except for the fact that it is listed on an exchange outside the United States and helps the issuer raise funds simultaneously in different markets like Luxembourg or London. The GDR is mostly traded on the European bourses. The method of producing a GDR is very similar to that of creating an ADR. These shares are held by a foreign bank that provides depository receipts to these companies in return for the shares. Companies can approach depository banks of various countries and make an agreement with them. Though both GDR and ADR are used to raise funds from the foreign market, there is a fundamental difference between both. ADRs are traded on the US stock exchanges, while GDRs are traded mostly on the European exchanges. In case of ADR, Indian companies can only trade in US markets, but in GDR, issuance companies can trade in any market other than the US. Typically, ADRs are bought by the retail investors while GDRs are bought by the institutional investors. Depository receipt or DR help companies tap the overseas market for their equity capital needs. DRs are typically issued in markets where there is a possibility of getting better valuations than in the domestic market. Several Indian IT companies and banks have an active ADR program. DRs can also be issued during cross-border mergers and acquisition. Issuance of DR provides a simple means of diversifying a company's shareholder base and accessing overseas markets and other developed global markets. Issuing DRs may increase the liquidity of the underlying shares of the issuer. It also allows Indian companies to raise capital on a scale which might prove difficult in the local market.
I will achieve, I will fly high.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Listing through depository receipt also increases the issuer's visibility and recognition in the international markets, which may ease the path of future capital raising exercises. That's all for today. For more news and analysis, please log into our website www.business-standard.com. And we'll also be back tomorrow morning with more. Stay tuned and thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.